Hi, everyone, and welcome to Bitcoin Analysis Beyond the Block for February 2024, brought to you by Ainsley Crypto. My name's Chris, and today we have assembled a great panel of experts to update us on where we are in the Bitcoin cycle with some analysis and discussion looking at the macro fundamentals, market and on-chain technicals, and everything else in between. How are you going today, team?
Not too
Hi,
bad.
Chris.
Really look forward to this video.
Yeah, this is great. Now, this is something, it is a bit different to what we've done before. We've got the three of us here today. We're trying something more of a panel style because we've identified that in the market, there's a lot of people out there who throw their technical analysis around and their market analysis around, but they don't really pull it all together. So I'm hoping we can do that a little bit differently to how it's done elsewhere. And I think we've got the right people with us. So thank you for joining us. We might start off by really exploring this idea of how we should look at the market. And our approach to that, I think, is going to focus on really a top-down approach by starting off with this idea of macro. So we've got a bit of a macroeconomic analysis to begin. And then we can dive into Bitcoin specifically to look at what's going on in the Bitcoin market, because there's plenty that's been going on there recently, and then venture into the technical at the end, because I think the technical really helps us pull it all together with some specifics. And I know that's great to have you on here, Isaac, because that's an area that you're really quite an expert at. So I think we've got it all together. We'll see how it goes. It's our first go at this, so we're really looking forward to putting it out and getting some feedback from the audience as well about what they want to see. But yeah, let's dig into it and see what we can do.
Let's do it.
So starting off with that economic analysis, we've got a chart here that is probably a really good place to start, really big picture, looking at where we are in the global macro cycle. And what the global macro cycle can be thought of is we know the idea of a boom and a bust, right? Like, so when you think about that in the economy, you go through recessions and busts. That would be what we would call this red bust period at the bottom. We go through recovery, which is this early cycle. The mid cycle is sort of the golden zone we want to be in, where everything's going pretty well. And then we get to the end of the cycle where things start rolling over, leading us to start a brand new cycle again. That's why it's called a cycle. So it's important to understand that as the big picture to give us at the very top level where we're heading when we start looking at something like Bitcoin specifically. So looking at this chart, I think we could all agree we went through a bust during 2022. We certainly had that late cycle and the bust in Bitcoin. No one can argue that. We went through quite a bear market. And then we have seen last year really these early signs of a pickup that occurred, and really a great time to enter at the start of last year in that early phase of the cycle. The biggest takeaway for me from this graph or this chart is that we're not at the end of the cycle yet. So we've already seen a lot of price appreciation in something like Bitcoin, which of course we'll get to a bit later. But people who get a bit scared here and go, oh, but the price has gone up, should I be leaving the market? Well, as you can sort of see from this chart, we're still very early. We're in the early cycle. We still haven't really touched the mid-cycle yet. Is that how you would look at it?
Yeah, looking at that, I 100% agree. This grounds you, it gives you that perspective. And seeing where we are now, coming from the bust, entering the early cycle, we still have a lot more way to go. And as you can see, the mid cycle is going to be next, and then you've got the late cycle. So I think we have a lot more to go. And I know obviously Bitcoin has appreciated a lot since you had the bust and around that region, end of 2022 to the start of 2023. But we still got a lot more to run just based off the cycles here.
And Joe, like, this is one probably for you. This was interesting because the data, now this, remember, we're very data driven in this whole approach. We had this early cycle start to emerge in early 2023. Then we got a little bit of mid-cycle data here, and then it went back to early cycle. Now, I would argue that we're probably more in early cycle than mid-cycle. Sometimes you get that sort of data anomaly, but like, I think that shows it quite well. We're not even at the sort of halfway line. That's that halfway mark there. We're not even at that halfway mark yet. So you wouldn't really be expecting to see mid-cycle data at that point. So you can probably ignore that a little bit. Is that your take on that?
Yeah, I agree. When you look at a lot of the data points outside of what this chart is that you generally see coming from the Fed or coming from the Twitter or whoever's posting, you would say that a lot of people are still looking for that recession so they think we're still going through that early cycle or possibly still in that bust phase. So even though we've got that little bit of mid-cycle there, I would say that that's definitely, that makes a lot of sense to me, that chart, that we're still in that bottoming out phase, getting into that early cycle and about to move into the mid-cycle.
And that's a really important point that you raised, because we certainly could roll back over into late cycle and bust from here, right? Like, it's possible, but that's not usually how this goes. And people who are really calling for the recession probably miss the fact that, like, from a macro cycle perspective, we actually have gone through the worst of that already. So that's really dangerous. People get caught out. And this is why, people often end up on the wrong side of the market, because they're waiting for something thinking that it has another leg lower. The data is not telling us that. The data is very clear.
And there's still a lot of bears out there, and I think that's the reason why they're looking for that bust that really brings down the markets into a new lower low, when the data at the moment is telling us that that's not necessarily what's going to happen. So heading in the right direction as far as I can see.
Absolutely. So this next chart, the ISM, this is something I know, Isaac, you wanted to talk a little bit about, and Joe, you probably have words to say about it as well.
Yeah. So just looking at the ISM here. Now, if you've done with the ISM, I'll briefly explain it. It basically tracks the orders from supply managers, so you can see what's coming into the market. So right now we have the ISM and the ISM new orders. Now, the new orders is a 1 month lead, tends to go track it. And as you can see here, we've seen a subsequent tick up above the 50 range. Now, on the bottom corner, I've got ISM equals expansion, ISM less than 50 equals contraction. So as you can see here, we've seen that rise up above the 50 mark on the new orders, which means we're probably going to see that subsequent push up on the ISM, which is a good indication of expansion. Further going and further, mapping that towards the macro cycle before, really solidifying that bias that we're going to be trending higher. So you actually can see there, we've bottomed out and we're now rising up on the new orders, which generally means we're going to be seeing a rise up in the ISM. And if you looked at the history of it, it's had there's a very high correlation between the two. So that's my take on it. I think we're going to be heading higher looking forward. So obviously expansion is to come.
So I'll just add to that. When looking at this data in terms of the markets, we need to remember that the markets are also forward looking, which is why even though we're still we bottomed out around that 43 and we're still effectively neutral around that 50, the markets are rallying off that because markets are forward looking. So that's the key takeaway from here as well.
Yeah, really important point. If you're trading on where we are today, that's kind of missing the big gains, because the market's always trying to front run those gains if it sees everything turning up, isn't it?
Yep, that's correct.
Yeah.
Okay, so we've got that big picture overview of what's happening with the macro economy. We tend to go a step further into an area that we're really passionate about, which is global liquidity. And the reason we focus on global liquidity is really highlighted perfectly with this chart, I think. So this is saying global liquidity and world financial asset prices. And it's showing that and this goes right back to the 1970s, showing a very high correlation between what's going on with global liquidity and what's going on with asset prices. Now, that's what's going on here. You don't have to understand this specifically, but it's showing you that there is actually causality testing that you can do. So statistical methods that you can use that effectively prove that global liquidity is causing world financial asset prices to change. So that's really important to understand. We'll talk further about this, particularly in relation to Bitcoin, because if you look at gold, crypto, meaning Bitcoin in this particular graph, and global liquidity, you see that it has been connected for a very long time, that the relationship is very strong between gold and crypto. What I love most, between gold or crypto and global liquidity. And the reason for that is because gold and crypto, or gold and Bitcoin, are considered to be monetary inflation hedges. Now, I know Joe will talk about this a little bit in a second, because this is an area he's really passionate about. But what I find fascinating about this chart is when you speak to most people about what's been going on since the 70s, they will talk about this bottom dotted line, which is inflation, or consumer price inflation. And this is showing you the prices of things, everyday goods and services going up over time. We all notice that, and we all pay a lot of attention to that. We hear about inflation numbers all the time coming out of all of the economic sort of institutions. But what they tend to neglect is that there's actually been a lot more, this black line, money injected into the system over that period of time than what is reflected through consumer price inflation. And a lot of assets are not, they may well be keeping up with consumer price inflation, but they're not keeping up with the overall level of global liquidity that's being pumped into the system over that long period of time. The only thing that has effectively is monetary inflation hedges, which in this case is gold. Obviously, we didn't have crypto back in the 1970s, so we've incorporated that into this chart. When we get to 2010, Bitcoin then forms part of the metric. But it's just showing overall that something that's designed to sit outside the system and really serves its only purpose as keeping up with that monetary asset inflation is doing quite a good job. Did you have more you want to say about that, Joe?
Yeah, so if you're just looking at that black line, we're talking about liquidity, and we'll delve into that in the next couple of slides as well. That black line is effectively just a proxy for the debt as well, like the debt cycle. So as we'll see, it's the debt cycle, and the amount of debt that's been piled on is up and to the right. So it makes sense that as the debt continues to grow and liquidity continues to grow, financial assets, specifically gold and Bitcoin here, continue to get bid up. If you're looking, I suppose the other thing that you were talking about there, Chris, was you've got your inflationary consumer prices, like the everyday goods. That's all good and well, but what people also want to own is, apart from the things they need from day to day, is they want to hold financial assets to protect themselves. So as each passing year goes by, they're actually able to afford less and less financial assets to protect and store their wealth. And that's where gold and Bitcoin have done a fantastic job over the last 13 years for Bitcoin and gold historically over the last 4 to 5 decades.
That makes a lot of sense. And going on to that next chart, it really brings it home even further, because people go, well, should I just buy and hold, right? Like that's the argument that everyone uses in crypto, particularly with Bitcoin. Buy and hold, you're better off over the long term. That may well be true, but there's also cycles within that global liquidity that we've been able to identify. Did you want to talk about this chart a little bit, Isaac?
Yeah, so this cycle, as you can see here, we have the sine wave overlay on top of it, and they've just done it to match the troughs and the peaks and all that. So as you can see here, it's been quite timely, and it's matched the tops and bottoms pretty well. Now, as you said before, holding, if you just hold, you probably perform quite well. But if we can track this and we can find out when to enter, when to exit, we can then formulate a better plan and potentially even make more gains. And not just potentially, I think you very well will make more gains following that method. Now, as you can see here, dating back to the 1970s, you saw the rise, the decline, the rise, the decline, and you can see how it matches quite well with the sine wave there. Now,
well, and it's become really exaggerated towards the end here, hasn't it? Where it's really following.
Yeah. And that's probably due to the debt burdens increasing, and we're probably going to see that going forward into the market as we go in. Yeah.
So if we apply that model, that's what we've done here. We apply that. So this line is that global liquidity index that we were seeing on that other chart, being applied over the top of Bitcoin. Do you want to explain this? Because I think this chart is just fascinating.
Yeah. So this chart right over here, we can see we saw the bottom in those two bottoms. So we got 2018 and we had 2022. Now, those are the bottoms of the global liquidity cycle. And as you can see with Bitcoin, it bottomed out really right near the bottom there. Now, obviously, we're going to be using other tools, right? So it's not just like using this alone to measure your entry points, but it gives you a good indication. When we're entering those orange red zones in the liquidity cycle, we start to look for entry points. Now, even with the one 2022 low in November, that was a very nice signal. It was flashing red, and Bitcoin's entering that capitulation. We're seeing different metrics say buy, and that's like, okay, you got to start thinking to yourself, well, now I would probably want to enter here for your long-term positions to hold. And as we've seen a subsequent push up in the global liquidity and with the Bitcoin price, just further tightening that correlation between the two.
I'll just zoom in on this next, because this next chart looks at the same thing. It just zooms into a 5-year view, like a closer view.
Yeah.
Really, this highlights that last cycle, doesn't it?
Yeah, it does. And as you can see, we saw that work out really well. And, you can see here in the past one, it flashed green, right? Before Bitcoin had its, parabolic run. But nonetheless, that's just telling you a good region. Well, I could look to start scaling out now. And as we've talked before, if you bought in the red and if you go back in the previous chart, even if you sold at that green at the top there, you're still talking about multiple percentage gains, multiple
Yes.
X's, sorry. So it's not like you've really missed out on a stack. I mean, you've missed out on completely taking advantage of it, but you've obviously made a lot of money during that process, matching them up together.
And that's a really valid point, because when it doesn't matter even now, right? Like I've sort of said this before, if we are at this point now where we've made a really good entry because we identified that the liquidity cycle was bottoming out and the macroeconomic cycle was bottoming out, so we're back here somewhere we entered, we're actually already in a lot of profit. But we can also use this to say, well, it's not necessarily time to take that profit yet, because we're still early in the cycle. We haven't even reached that, in this case, that sort of halfway mark on this side, on this indicator either. We're still very early in the global liquidity cycle. Based on what we saw before, it follows that very reliable pattern. So there's more indication from this macro point of view that now would not be the time to be exiting. Like, you could potentially still be building a position even. So we've got plenty of runway left ahead, and that's really important for a lot of people, I think, who start to panic a little bit when the price goes up.
Yeah, and I just think it's very important to look at this, because right now I know a lot of people who will be looking at the price right now. We're reaching these high levels, right? And you look at other metrics, and maybe one metric says sell, but it's good to keep that grounded base and to look at what the overall liquidity is doing and the macroeconomic background. And we can, you don't have to panic. So we're in that stage where we don't have to worry so much. We can look at this, and then you can start to see the percentiles up there. We've got, if we hit like 70s, from there onwards, you could start to seriously think about, okay, I want to start scaling out based on other metrics too, with the framework we've developed.
So that's an excellent segue, because now I think we've really covered that big picture macro view of where we are in the macro economy. So that's really everything outside of Bitcoin itself. It's now time, even though we've been applying it to Bitcoin, obviously, it's now time to move in and zoom in a little bit on the Bitcoin market and what's been going on there. So let's start off. Yep. You've pulled a few things together for us here, Isaac. I'd love for you to sort of step us through, and we can ask some questions around this. Start off with this, which is quite a technical one, this MVRV score.
So what this one's basically doing, it's tracking the realized price and the market price, and it's using those metrics to formulate how far is the market price away from the realized price. And the realized price is basically the conglomeration of where the last transacted Bitcoin was. So they match it dating way back. It's that blue line, as you can see, right? When it gets very far away from the market price, it means a lot of holders are actually in profit. Now, if you look back in the capitulation zone down there, where the realized price was actually, above the market price, meaning a lot of our holders were in losses. Now, this is actually a good sign to look for a buying opportunity. So you can track that through the green bands in the bottom, which is the 0th standard deviation. So just the equilibrium point. So you've got there 1, 2, 3, 4 points you can see there. And those were pretty much the market bottoms. Now, that's a really good metric, timing that with your global liquidity to be looking for an entry. Now, going over to where we are now, looking into the resistance sides as we're seeing that push up, what we've seen is during the euphoric stages, the deviation score, the MVRV score, goes up very high. Now, the peak it reached was around 9.5, as you can see at the top there, and it started scaling down to like 8.5 and 6.5, as you can see there. And I've drawn a trend line.
So that's this trend line that you've got is just showing that the spike didn't hit as high each time. Is that what you're trying to show?
Yeah, and I just think that's because as the asset gets more adopted, it's just gets less and less volatile as we go further in the future. So as there's more people holding it, and it's that's what tends to happen with assets as they go further in the timeline. So as you can see here, what we'd be looking for, we wouldn't be looking for a 9.5 deviation at this current point. We'd be looking for tracking that trend line somewhere between the 4.5 to the 4 region extending forward, or even higher, but you have to base it off other metrics too. You wouldn't just be going solely off this.
And a point, like, probably just to make the point that these variations being so large is just extraordinary in any market. Like, you wouldn't see this anywhere other than Bitcoin, really. So it's a very, the fact that it's coming back down to still extreme levels, but probably somewhat more normal levels, kind of makes sense against the backdrop of what's been happening with Bitcoin and its adoption, I suppose.
Yeah, and as we go further along, I truly believe those, the gains will become less, and the Z score is gonna decrease as we're seeing now, and I think we're going to see that decrease even more going forward.
And that's a healthy thing, is what I'm sort of getting from that. It's not necessarily a negative that's coming down and being less volatile. If anything, that might attract more people to the market. So if we move on, you've got to this next chart, which is looking at it from a slightly different angle. Can you step us through this one?
Yeah, this one's very similar. It still uses very similar metrics. So this one gives you a score. You've got 100%, 50%, 0, and then you go down. These can actually go further, but this is where they tend to stop. So the 100 percentile is the euphoria/greed stage, which means a lot of traders are just holding and they're refusing to sell, even though price is reaching really wet, like really far away from the fair value. So it's really high, and the people who are holding are just keep holding. They don't want to sell. Now, that's what happens when you get to euphoria and greed, and they're thinking price is going to appreciate. This is like when we had the last cycle and people were saying Bitcoin to $1 million, and they just kept holding, and they ignored what happened. So what we can be doing is looking at where are we in it. So, in the last cycle, you saw it reach euphoria and greed. You can't be looking at euphoria and greed and saying, I want to enter a position now. You have to be looking at that and saying, I'm looking to scale out of my position, matching that with other metrics, as we've gone over in the previous slides. Now, in the trough that we saw down the bottom here in 2022 to 2023, we were in the capitulation zone. Now, this is a zone where you're looking to enter. Now, this is because a lot of traders are in losses and a lot of people are actually selling into the lows. And as a smart trader, well, not trader, as a smart investor, sorry, you're looking to enter there. And that timed in pretty well with the global liquidity cycle. And it just furthers that bias to look at, is the liquidity cycle trending up? Is the ISM trending up? Okay, is the MVRV ratio going up? We start to look at that, and that's how we formulate that plan.
See, I find this great because if you look at where we've come so far on this journey in this presentation, the macros side of it was sort of saying early cycle, right? We're still pretty early there. And what you're saying, particularly with this indicator here, we're in that sort of belief denial phase there. We're touching into. So we're just coming out of this optimism. So we're certainly not at the extremes yet, is what this would be saying, which is consistent with the metrics we've had so far.
And just looking at the price, I think we have a lot. We haven't hit that euphoric stage yet, and that's also exemplified in the global liquidity metrics. You can look at, when we start to see that euphoria, the global liquidities are higher, and we haven't hit that yet. And even just looking at the sentiment, which we'll get to next, we have not hit euphoria, and this furthers that, saying we are in that stage of denial and belief in denial, sorry, and people are starting to think, well, maybe this is the move happening, and this is where people start to pile in. So over the next few months, we're probably going to be seeing that start to occur.
Joe, did you have something to add?
Yeah, I just looking at that chart historically as well. When it really enters into that belief denial, that's when you get that serious price action. That's when it really starts to swing up. And so people who are thinking that they're possibly a little bit late here because we're fairly well off the lows, there's still, just based on this one data point, obviously we're going to mix it with others, there is still a lot of move to the upside to be had over the coming 6 to 12 months, I would say.
I can certainly agree with that. You've got another chart here, which is one that looks a little bit confusing at first sight. Do you want to talk us through that quickly, Isaac?
Yeah. So this is the CBBI historical chart. It's a metric that a lot of in Bitcoin holders track, and you just got different metrics like the pi cycle top, and they just give you a conglomeration score of to where we potentially are in the cycle. So if you look at the colorization visuals, you can see that the red zone, where it's very red, means extreme euphoria, and we are definitely probably at a top, and it gives you a score. Now, if you look at the rainbow on the bottom, it's 0, 50, 100. Now, when you're at 100, it means the top is probably in, and the way it measures that is tracking all these metrics. Now, the metrics we went over before, MVRV and the other chart, they are actually in this too. In the orange band, you can see the MVRV is there too. You've got the 200-year moving average. You've got other metrics there too. It's a conglomeration of different metrics that give you a overall score. Now, where we are now, we're seeing that yellow/orange stage. Now, this is really just the pre-euphoric stage. This is the pre-giant run up to the break all-time highs. And I think we're going to be seeing that relatively soon in the next few months, once the halving sort of comes through and extending onwards. That's what you would expect. Obviously, anything can happen in the market, but looking at the data suggests that is what's going to happen.
Okay, so moving from that sort of, you've had some very specific measures there to sentiment analysis, and this is something I've always loved, sentiment analysis. It really gives us some insight into what we feel and how everyone else is feeling against that backdrop as well. Can you maybe step us through? You've actually got 3 measures to talk about today. Can you quickly sort of step us through each of those, and then Joe, I might get your insights into how you feel it aligns with your personal perspective.
No worries.
Okay, so I'll quickly explain it. So basically what's going on here is this is the fear and greed index. And when it reaches those highs, it means the market is extremely greedy. And when it's lows, it's very fearful. So as you can see here, with those bubbles I've drawn, so to the left one, as you can see, we've reached extreme greed. Now this is in the 2019 run, and price had that extreme greed and it peaked and it came down. But a point I would like to add is that wick on the lower side hitting $3,000, that was a COVID low. Now that was drawn by fears of, the world ending. So that's a freak anomaly, and I don't think it would have done that. I think it would have just sort of traded on a consolidation and then seen that rise up, opposed to just dipping down a ridiculous amount. Obviously, we didn't know what was happening at that time, and we saw that. But before, see the second dot there, we're reaching very high levels of greed, and a lot of people would look at that and be like, I might want to exit because everyone's greedy. And the famous Warren Buffett quote, what he says. So based off that,
buy when others
maybe I should exit.
Yeah.
Yep. Now what we saw there is you wouldn't want to exit there because we saw the giant run up there,
what happened next,
right?
That's right.
Yeah. So looking at where we are now, you could probably tie that into that last segment and say, we're probably at that stage. And even based on the other metrics, it would suggest so.
I think the key part of that chart there is not to necessarily, like, you can have those dips in sentiment and the price not really dip down, particularly when you're in a bull market, because it is so extreme. I'm looking at that chart. I'm surprised that it's at 74, that it's quite that high, just from the general sentiment that I see through Reddit, crypto, Twitter, and just content, for example, YouTube content. So we'll see how we go, but that seems a little bit high to me.
Well, I think that's interesting against this next. We'll go on to the next indicator, because this indicator actually tells a slightly different story, which may align closer with what you're seeing, Joe.
Yeah, 100%. So yeah, talk us through that one, Isaac. And I think that one's saying it's probably a little bit more, well, from what I can tell at first glance, the market's a little bit more bearish compared to where the price action is actually trading. Yeah,
I'll quickly explain this one for you. So it's a Bitcoin sentiment score. It just uses an AI model to track and scour Reddit, Twitter, Bitcoin Talk, and it gives you an overall score. So right now we're sitting at 0.46, which is slightly more on the bearish side, but leaning towards more neutral as to where we are right now. So if you go on the right side, you can see XBT USD. Now that's the Bitcoin price. Now what we've seen is a rise up in the white line, whilst we've seen a decline in the sentiment score. Now, I want to hear your take on that one, Joey, because that's an interesting, and I think it sort of aligns with what you were saying before. But yeah, so it tracks and conglomerates that, and it gives that score. But yeah, I'll let you take that one away.
I think it possibly has a lot to do with the institutional flows, which we'll talk about next. With the ETF coming out, we've obviously had a large run up in the news that the ETFs were going to be launched. They're now out. We've had reasonably good price action, but maybe not the price action that retail was expecting, which is basically what we're measuring here. So I think even though we're up, 25% since the ETF launched, we had that initial dip, I guess people expected more. So,
well, and my take on it would be, across both the ones that we've seen so far, this one more so, it's actually quite encouraging for the longer term health of the market to see these numbers not taking off now. Like, sometimes people really want to see, everyone being bullish and the sentiment being very high, but I tend to look at it the opposite way and go, this coming down is actually a really good sign for the health of the rally, that the rally can continue, because this is ultimately it's a contrarian indicator, right? Like, we want to be buying. That was the Warren Buffett idea before. You want to be buying when others are fearful and selling when others are greedy. So this helps us, right?
100%.
Yeah.
That's basically telling us that the retail haven't thrown their money into the market yet. So there's still potential buyers sitting on the sidelines with cash. They're not FOMOing in.
Yep. Okay, so let's look. You've got one more sentiment analysis indicator here, which is the Google Trends. You want to just talk about this because this is one that I think is quite important as well.
Yeah, so this one over here, we've just got crypto, Bitcoin, cryptocurrency, and ETH as the main metrics and trackers. So as you can see here, what we've seen is leading up to the ETF, we've seen a spike in the interest in search terms, but nothing that suggests euphoria. Now, if you look back in 2020, that region down there, you can see the search volume was very high, way higher than what we are now. So it really just shows, it really just shows retail really isn't in that strong way, which is a very good sign for that push and that rise in that euphoric stage. And even potentially when we break the high, that's when euphoria floods in and we see that crazy price action. Considering we're nearly at the high, we're only like 30% off, sitting at like 51. So we could easily see that and then euphoria pile into the market, and we'll see that subsequent search trends start to rise, in my opinion.
Very similar to what I said before. Like it lines up with the other things that we've mentioned, that we're not at that later stage of the cycle yet. So people who are panicking and feel they've got to take their profit or sell just because they've made profit already, substantial profit already, now is not necessarily the time, because so far we've got nothing to indicate that across everything we've looked at.
I also think it would be good if we had a little flush out in the market, because then what that could do is, seeing that rise up, we could start to see those people who actually took profits realize, oh no, this is actually going to start running away from me, and pile back in, furthering their feel for upside. So honestly, a flush could be nice.
Yeah, I would agree with that. This monthly Bitcoin analysis is brought to you by the Ainsley Group, Australia's trusted choice to buy, sell, and swap gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Okay, Joe, we're now going to sort of focus in a little bit more on something that's been really a important topic that everyone's been looking at recently, the flows in the ETFs. Now, I know this is something you've been following extremely closely. It's very interesting, really. So can you maybe start off by giving us a bit of a bigger picture overview of what's been going on there, and then step us through some of the charts that you bought today?
Yeah, no worries. So the ETFs were approved. You had the existing GBTC, which was a trust, which is that big blue line on the left, and the other 9 ETFs were approved on January the 10th. So obviously, GBTC had a large hoard of Bitcoin, over 600,000, which weren't freely available, but then became freely available once they were converted to into a ETF, so they were able to be sold. What we can see here is, it'll be more detailed in the next charts, but you can see that GBTC started had a lot of outflows on their funds. So you can see those on the days we've had a dip. We've actually had negative flows in the ETFs. You just look back.
So that's these bars here that drop below the zero line. Yep.
So that's heavy flowing from GBTC. You could just look back to that previous chart, Chris, for us.
Yeah.
So you'll see that they are losing funds at GBTC, and there's a couple of reasons for that. So investors only had one way of getting exposure, institutional exposure, for quite a while, which was GBTC, but now they have more traditional firms like BlackRock and Fidelity and VanEck. So you'll see they're bleeding a lot of Bitcoin to them. GBTC also has quite high fees. So I think they're sitting at about 1.5% for their fees, whereas the BlackRock are around 0.25%. So, the third reason as well, there's actually been a lot of forced selling. So when you think back to the FTX saga, we had Genesis, we had FTX, we had even Gemini at the moment as well, I think have forced selling of shares. So GBTC have definitely been bleeding a lot of Bitcoin due to those few scenarios. So if you flip to the next slide, this is a day-by-day net flow or outflow index. Initially, we had a large amount of Bitcoin being bought. Over the next 2 weeks, we saw some quite not large outflows, but generally due to GPTC selling.
Well, it would have to be that, right? Because people wouldn't have bought today and then sold a week later from those other ones. Yeah,
that's right. So as the GBTC selling has started to subside, the net inflows into the ETFs have really started to take off. So as you can see, over the next three weeks there, we've had some serious net inflows. Like, we also got to consider that only 900 Bitcoin are being created every day through mining. So when you've got days, even on the lower end of those days, we got 3.2 there on the 7th of February. That's still multiple times of the actual newly created Bitcoin that have been mined each day. We also
just on that point, and I've seen this commentary come up a few times where there's debate over, was it a good ETF launch? Like, this is a spectacular ETF launch compared to others historically, isn't it?
Yeah, so looking at the first month of inflows, it's blown every other ETF out of the water. Out of thousands of ETF launches, the Bitcoin ETFs as a whole have been the most successful ETF launches in history.
Yeah, that's really quite significant. Like, that's
quite
an achievement. Yeah,
quite it's fascinating. And yeah, so people. So just look back to that last one again, Chris.
You're still on that one, yeah.
Yeah. So yes. So Monday was a bank holiday. So looking over to the far side of that chart, we had a little bit of inflows, and then on the Wednesday we had negative flows. So I'm not sure what was going on there, because a couple of funds, I think Fidelity reported zero net inflow, so I'm not sure if something was going on there. Just to update you for today, I think GBTC had a negative 53 million Bitcoin dollars worth of Bitcoin sold, and I think Fidelity on its own was 140 or something like that. So we're going to see some serious positive net inflows coming from yesterday's trading day.
And that's actually interesting, because I think I was listening to you actually talking about some more of that forced selling that was potentially going to put a lot of pressure on over this period of time.
Yeah.
What was that?
So there's a little bit of speculation. So it could be Genesis, which had the approval from the courts to sell, I think, around $1.3 billion worth of GBTC shares. So that's Bitcoin that the market has to absorb. So it could also, I've also read that Gemini have also got some forced selling from a couple of things that happened back from FTX. So we may see a bit of forced selling continue the rest of this week and possibly into next, but eventually those flows are going to subside. So like I said, there was only $56 million worth of GBTC sold today, which is, I think, might have even been the lowest day.
Yeah, right. So even, and we do have to remember, this is probably an important point there, that it's known, right? This isn't unknown that there's forced selling and stuff that's coming. It's not a surprise to the market. It's quite possible that you've got some of these market makers taking advantage of that forced selling and saying, "Yep," putting their hand up, "Yeah, we'll take it. We'll take that you've got to get rid of." So it's it's really performing very well compared to what people would probably, if they're criticizing it, I don't know what their comparison base is. That's how I would word it.
Well, that's right. And that forced selling, like I said, it's only going to happen for a short period of time, whereas these ETF flows are going to be happening perpetually into the future for the rest of time. So anyway, people will say all sorts of things.
Absolutely. Is this chart just the sort of dollar value of that?
Yeah, so you've got it's a couple of days out of date, but so you've got 5,000 million, so we're up to $5 billion worth of net inflows in terms of dollars. So the previous chart was Bitcoin, this is now in dollars.
Yeah, right.
And last one, so this is just a comparison of different institutions' holdings of Bitcoin. So a lot of people talk about MicroStrategy and the amount of Bitcoin that they hold, but we're already looking at the newborn 9 ETFs surpassing MicroStrategy and quickly catching up to GBTC, who are also losing coins at the moment as well. So it won't take long, maybe 3 or 4 months, we should be well past GBTC.
And that's not a small achievement to get bigger than MicroStrategy there, because people might not realize that, even those who sort of follow Michael Saylor, and he's been talking about it for a long time and accumulating. And we were hanging off for, it seems like, for years now, the Bitcoin market's been hanging off every word of, oh, he's bought some more, and then in a few weeks, boom, overtaken it. So that really does visually show how big that was.
and that's just going to keep growing. It's going to continue growing, and the flows are going to have forever upward pressure on price. So yeah,
it's going to be very
100%.
interesting to look at that chart updated in a couple of months.
Couple of months time. Yep.
Okay, so we've really, I think we've met our goal so far of starting at that big picture top with the macro. Then we've looked at the Bitcoin market generally, like what's going on there. This is now where we get into the nitty gritty, the nuts and bolts, and really why Isaac's here with his sort of expertise on this to step us through some of the specific technical points that people should be looking at. Now, I like to sort of preface this by saying we're not necessarily looking at this to trade in and out, but I do think we need to understand what's going on as part of building that complete thesis of what we should be doing with our longer term hold. And to be honest, it makes a lot of sense to be paying attention to this stuff to keep your eye on the prize and your head in the game when we're talking about Bitcoin, because these cycles, when we look at that macro stuff, is over years. The Bitcoin market stuff, we're talking, even Joe, you were just talking then over weeks and months, and some of this technical stuff can be even narrower. So I think it is good to have this as the culminating part of that, where we get into the specifics. So take us away with this one, Isaac, because this is probably what a lot of people are familiar with, support and resistance, starting out here at the weekly level. Can you give us a bit of an overview?
Yeah. I just would like to say it's important, especially if you're trying to look for entries to get in. Say you didn't get the exact low and you don't want to get a price that's unfair per se. You could be looking at these metrics to try and get that better entry. But anyway, I'll explain what we're seeing right now. So I'll start with to the upside. So to the upside, the major resistance levels I'm particularly keen and looking at are the volume node. So if you go look at the volume profile from the previous range, you can see the volume node is quite large and it's sitting at around 57,000 actually. And that's going to be a decently strong resistance because it also matches up with a SR level there too. So you're going to be looking to
people who don't
that.
understand what, and including myself here, don't understand what this means. This chart here is showing us the level where there was lots of volume in the previous move. Is that correct? So what you're saying is effectively, because there was a lot of volume there last time, it was a point of interest to the market, a point where lots of people were trading back and forward, and therefore this time around, often that repeats, as in it'll be a point of interest.
100%. And you can even look at the previous bump before. So if you go below that one there, you can see price stopped there. That was also accompanying with the Fibonacci level. So yeah, just that, if you go to the left side, the less volume profile, and the one with the red line coming out of that, if you match that outwards on a horizontal, you can see price stopped there.
Yes.
That was around the ETF level there too. And we've seen that subsequent drawdown there, and now we've risen up. So, and even down with the previous bumps there before, price stops there. Accompanying with that, with other levels too, you can see levels where you're going to see resistance. So we've got that one to get through, which is around this 57,000 region. Once we've passed that, we have a monthly level. Now, a monthly level is essentially the body closes of the monthly, and that's that peak sitting around 61,500. A lot of traders look at that level, so I think that's important for you're going to probably see a lot of traders trying to short sell there. And yeah, nonetheless, that's just where traders will be looking at to take profits and all that kind of stuff. So keep that eye on that level as a resistance level. And a major one, which will be very important, is the swing failure pattern high, which is the all-time high, obviously, which is 69,275 on the Binance chart here. They're all different depending on which exchange you're looking at, but around that region there. So that's going to be a very important level. What we could potentially see going up to that level is a rise above and a dip back down temporarily, as a lot of traders will be trying to, as we go above the highs, a lot of traders tend to short that because it's a liquidity region. But nonetheless, we have formed our long-term bias and we're looking towards higher prices, and we'll be tracking that with the other metrics. But key level to look at is that high there too, and I've written down 57,000 because we have that volume level there too. Now looking
and
towards
that all-time high, just on that point. So this is really a good point to highlight it, because we lose. There's none of this once you pass the all-time high, right? Because it's all brand new price discovery. So this idea of a clear blue sky above that level means that we actually don't know where it can go, wherever it likes, because there's no established support and resistance lines. So that gets pretty exciting when we get up there, doesn't it?
And really, all you've got at that point from a technical perspective is looking at, RSIs, momentum indicators, and other metrics like that, and potentially a Fibonacci extension. That would really be all you've got. And at the end of the day, it's still mainly guessing. So at least within price action here, we can kind of see where price saw demand and supply, and we can formulate a plan based off that. But as you said, blue skies, we don't know what's going to happen there.
So
Now,
you've also narrowed in on that on the daily.
Yeah, just going back to the weekly chart, I forgot to cover the support side. So if you look down here, if let's say we do have a retrace of a quite sizable amount, a good area to be looking to buy would be the 41,800 region. And I've also drawn the 28,000 major support there. I do not believe it's going to reach that level. That would be ridiculous. We're going to be seeing it. That's around a 50% retracement. I just drew it there for the sake of showing you where that support would be. But, obviously that would break the cycle. We're not going to be retracing 50% from where we are now would be probably that wouldn't it wouldn't match up previous cycles dropping that much. But nonetheless, I've marked
and to be honest, to do that, I would be expecting that we would be seeing something major going on right from the start of our analysis back in that macro.
Yeah.
Where there's something that's changed. That cycle is back down in the bust phase because something has happened. But I agree, I wouldn't be expecting that.
100%. But if we reach those levels of 41,800, and obviously it's just a zone, right? I'm not looking at the exact dollar. We're looking at that previous range zone, but I've just highlighted there with the weekly level. We've been looking to start accumulate, and we're seeing, momentum shift. And it's a good entry. It's a good entry point, especially accompanying that with what we've looked at before. Trending, we're going to be trending high in the long run. So you might as well stack the sats, right?
So you're on the daily, you're zooming in effectively, but doing the same type of analysis. That's correct?
Yeah, 100%. So what we're seeing here on the RSI, we've reached an exhaustion. So we're starting to see that EMA flip and the RSI go down, potentially signaling that we're going to be heading on the downside. Now, the stochastic, I would like to view that as a momentum indicator. We're seeing that, enter that 50% region on the bottom. So we can still see that fall there. And a thing I'd like to note is we haven't really seen a sharp decline in price as of now, even though the momentum's shifting down. But that could definitely come. But to me, we're actually seeing quite strength. And as you can see there with the wicks, with where we are, we're seeing that demand come in when we reach those lows. Now, obviously, this is short-term information. Don't take it with too much, but you got to look at it and be like, yeah, well, we could see that retrace down, right? And if we see the retrace down, we're looking at those levels there with the volume node 42,800, 41,600, and then we've got 49,700, which is a daily level, accompanying that with the previous high from the last range, which I've drawn there with the volume profile. Another region to look to be scaling in, DCAing in there. But technicals I find work best on the bigger term timeframes. Small term timeframes like daily, they're good, but you want to probably use them in accompanying with the other metrics which we've gone over before. But yeah, I think we could be seeing a decline in price action, but it wouldn't be nothing crazy, in my opinion.
And that aligns with what Joe was saying in terms of the demand we've been seeing from the ETFs as well. Like we can't look at this in isolation. That explains why those wicks have been where they have been. You mentioned Fibonacci before as a potential tool to identify levels, particularly if we get to that blue sky point. What are you showing here?
So this one right here is just showing the golden zone from the bull run, the peak to the low. Now, as you can see with the ETF, we saw that retracement after we hit the golden zone, which is the 618 zone. This is a zone where a lot of traders are looking at, so you've got to be careful for this region. A lot of people start to scale out, and we saw that subsequent push down, and now we're actually above the 618 and above the 66, which is a golden pocket, they class it as in the trading world. Now, that's actually quite a bullish sign, in my opinion, that we've seen that rise up so quickly. If you look in previous cycles, we didn't see that. We saw that retrace and sort of consolidated until the halving and then the push up. But we've already kind of broken that high, when we've hit the golden zone. So this hasn't really happened like this before. So I think, this to me, this is a bullish metric. And we've also, with the ETF inflows too, that we definitely have to do with it.
I saw some data recently where in terms of price action and hitting those fibs, it hadn't from previous cycles, it hadn't actually happened this quickly before the halving. So I suppose in a way that's about as bullish as you're going to get, really, isn't it?
And even the fact that we haven't seen the large, all the retail enter, which is a really good sign.
Yeah.
Which really goes back to what you said before about that sentiment. It's not at that really frothy level yet where we see retail come flooding in.
Yeah. All right. So this one is the order flow. It's the CBD. I like to use this one a lot. It's the cumulative volume delta. It sort of tells you the health of the move. This is really going into the skeleton of the price, and accompanying that with open interest to tell you, are we seeing trades enter, positions enter, or positions exit. So this is the spot market. The spot market really is telling you this one tracks, to me, it's more long term, right? This is why I've done it on a 12-hour chart so we can sort of extrapolate that back further to October. What we've seen is decently good price action and a healthy move, especially with the ETFs coming in here since that low, open interest increasing and your CVD increasing there too, which is
so just explain, because I'm not very familiar with this indicator. What does it actually show?
So this just shows the market buy and sells, and it tracks it, so you can see divergences within price. So what this can tell you is, are we seeing whales absorbing price or vice versa? So it tracks that. But I tend to find it works best on the futures market because that's where a lot of traders will be, and it's good here. And this is when I actually made that call before where I talked about, this is the buy bet chart, as you can see here. It's on the hourly, right? This is the futures market. What we saw was a push down. So if you look in the dates there, around the 17th to the 20th, you had the CVD tracking down whilst open interest was increasing, meaning a lot of new shorts were entering the market, right? Now, price was increasing and shorts were entering, which means there was probably someone or a whale of some sort that was holding price up. And that's why I thought we would see a rise in price. And we did see that rise in price taking out the higher of the range. And as you can see there, once we took out the higher of the range, we saw open interest decrease and CVD go up, which means short sellers got squeezed and they had to exit their positions via liquidations or self-exiting themselves. And we saw back to equilibrium now, and I don't see anything that particularly piques my interest where we are now.
Okay, so you're not necessarily using this as a good or a bad thing. You're more interested in divergence to identify where something is happening you're really using it to point out anomalies or where we can probably predict a little bit on the shorter term what's likely to happen next based on the way the traders are behaving in the market.
Yeah, it's more used for that, and I use it for that, especially for like the shorter term time trades, like on the hourly charts, and we can start to see those divergences form. And it really gives you an indication, coupling that with your open interest to see what's going on from the market side.
Well, that to me seems like about as much into the specific weeds as you can get with this. So I think we really have hopefully met our objective of sort of starting from the top and working our way right down. I think it's useful to look at it this way. I know I've gained a lot from going through this analysis in the preparation of it, but also in just discussing it today, because it really gives me that big picture confidence. My summary would be that everything still lines up pretty much with that very first chart, that we're still in that sort of early cycle phase, because nothing that we saw across all those different metrics we were measuring changed my perspective on that. So sort of to summarize, do each of you want to maybe give your final thoughts of what you've taken from that journey and what you're thinking in terms of what comes next?
Yeah, I'll go. So what I'm mainly seeing is, based off the macro, we're looking for higher prices to come as global liquidity increases, and the coupling up with ISM and even the Bitcoin market analysis with sentiment and your MVRV and your other charts I've displayed there. I think higher to come, so don't worry right now. Even potentially scaling in once if we see retracements, which is what I'll be doing. And yeah, I think overall the bias we should be trending higher in the near term future. And don't panic if we see a retrace in price action on the local timeframes.
Yeah, so taking that long-term view, as an investor, not necessarily a trader, all the data is pointing in the right direction. I think the only thing that outside of the usual technical pullbacks, which would be buying opportunities, would have to be some sort of black swan that would cause a market sell-off, in which case I would see that as a fantastic buying opportunity. since you know the playbook in terms of liquidity and the central banks pumping money back into the system to correct whatever's actually happened in the financial market. So, yep, I would say heading in the right direction. Pullbacks you want to buy, and if there's that black swan event, you know what the direction is going to be afterwards anyway, in terms of liquidity going into the system. So,
yeah, that makes a lot of sense. Well, as always, this is our first go. We really appreciate any feedback. So hopefully we've covered everything people want to know. We'll be putting this up, and you can comment on the usual places, the social platforms or wherever. Really do value that, because we'll continue to evolve. But our plan at the moment is that we'll be back each month to follow pretty much the same format. Look at what's new, go through all those charts, probably add in new bits and pieces as we go. We'll be bringing Josh on board as well. He's got some excellent on-chain stuff that he wanted to dig into to provide a little bit more depth with that side of things as well. So as I said, appreciate any feedback, really value that. And thanks everyone for watching. We'll chat again soon.
see you guys.
See ya.